right. Here we go. People are coming in. Welcome. Welcome, everybody. Excellent. Okay. Got some more coming in. This is great. All right. Okay, so we've got some familiar names here. Welcome, everybody. So thanks for being with us on this Thursday night. And of course, we've got Bob Gray, partner of Gray, Pilgrim and Associates. Been in the business for heck almost 30 years now, and we've got an accounting firm that's almost exclusively working with the dental community now, right, Bob?
That's correct.
Yeah.
We've been specializing in working with dentists for many years.
Excellent. And a little bit about myself. My name is Jason Nghiem. I'm one of the senior consultants here at Cirrus Consulting. To give you a little bit of background behind us, we've been around for 30 years, and our focus is to help the doctor with their dental lease needs. Heck, one funny thing I've always found is when I first started working here, our Wi-Fi name is Doctor Protector, right? So we want to look out for the interests of the dental community, in regards to, your new starts, your renovations, and heck, your eventual exits as well. So a couple of things regarding this current webinar. I'll put up a poll right now to get a sense of who's in the room and how we can tailor the conversation for you guys. Please have a look. So our topic of discussion today is, of course, avoiding common tax pitfalls. Considering it's December, taxes are on everyone's mind. We want to be able to avoid any kind of potential pitfalls there that may be coming toward you in regards to frankly, your renewals of your lease, but also your eventual exits. Bob, perhaps you've seen a lot that has happened over the last year or so. Any particular changes that has occurred?
Yeah, there's been, the depreciation changes are some of the big ones that, but we're going to talk about a number of those things tonight when we jump in, and I'll let you get kicked off first here.
Sure, sounds good. So let me load up the screen here. I hope this is visible. All right. So looks like we've got a good number of people that are currently, from the poll questions, a good number that are currently leasing their space, a couple that own their current spaces. We've got a couple that are looking to open or relocate their practice, some that are looking to transition in the next 5 years, and some that are looking to renew as well. Got a couple that also probably have signed a lease agreement in the last few years. The lease would be due in over 5 years, but some that are coming due. And we've definitely got a few that are looking to start or buy their own practice as well. Excellent. It's good. Okay. So to give you a sense of how Cirrus fits into this space in an effort to save you money when it comes to this time of year, the lease is a huge part of that. It's absolutely a huge part of that. The purpose of today's webinar, we're going to explain purchasing versus leasing your real estate, protecting your profits through that, the impact of the office lease on practice profitability. This has become a huge issue when it comes to the eventual exit. What we find is at the 11th hour, what happens is what really holds up the sale is, in fact, the stupid lease. So this has an enormous impact on your ability to eventually transition. Also, we'll go through a couple of case studies on how, your office leasing decisions can impact, your eventual sale proceeds. Also, a big piece of this is, is this the right time to expand or renovate or relocate or renegotiate your dental office lease? In addition to that, we're going to touch on, how much could you potentially save in terms of a lease negotiation or refinancing. Also, we'll go through some of the top tips on how to maximize your financial and business wins and your next lease negotiation. And finally, about that eventual exit, preparing for that moment, having that 5 to 10 year roadmap. So to give you a sense of how we fit into this particular picture, usually when there's any kind of lease negotiation to be had, whether you're looking to start your own practice and you're going to build out a new space, or heck, you're looking to buy a building, or heck, if you're even simply looking to renew your lease, you've been in the space for, let's say, 8 years, you already did one negotiation once, and it's time to renew. There's usually two key players here. The first one is the broker. Brokers they're quite useful. They're going to be an expert in regards to helping you locate the correct site to build. They'll also have the demographic data, also rent data to help you determine, how does your rent fit in regards to the rest of the market. The problem we found, though, is that it's simply a matter of the way they get paid. So for those that don't know, a broker typically gets paid by the landlord. They don't get paid directly by you, and they get paid a commission based on the amount of rent that you spent. So, for example, if you were to sign a 10-year term and that the total amount of base rent over the 10-year term, if it equates to, for example, $1 million, more often than not, the broker is entitled to a commission based on that of 4 to 6%. So the moment you sign that dotted line, that broker is going to get $40,000 to $60,000. So, while, of course, like I said, we find them to be useful in certain aspects of this, certainly helping you locate the space and so on. We find that, having their hands on the lease may not be as beneficial to you as is ideal, right? Additionally, a lot of people will utilize a lawyer to look over the lease, and certainly many of them will be experts in this matter, especially regarding the legal terms. The problem is most lawyers don't have any of the real estate data. When we're talking about a landlord, landlords don't solely want to talk about the rent. They don't solely want to talk about the legal terms. They want to have this conversation together all at once. That's where we fit in. So, again, we've been doing this for 30 years. We've done over 13,000 negotiations thus far. We've got 30 years of intellectual property to use to negotiate for you. And we're paid only by the dentist. We're going to treat this project exactly like it's our own money. And frankly, we don't stop until you get the lease that you're happy with. So in regards to that, who we help, let's say our bread and butter is, typically 3 types of doctors. Those that are looking to do new starts, or looking to, manifest their own dreams and create their own practice. Even for those that haven't found the space yet, I'll show you in a moment some of the data we can utilize to help you identify what spaces will be the correct one for you. In addition to that, those that have already found a spot, they're in the space, maybe they've purchased a practice, they've had the lease assigned to them, and now the lease is coming due. This is a huge moment for potential savings here because, well, frankly, like we'll talk about a little bit later, dentists are the greatest tenants on the planet. Landlords love having dentists. And finally, who we also work with is those that are looking to transition. They're creating that 5 or 10-year plan to do so. Again, the lease has an enormous impact on your ability to, one, sell, and two, to sell profitably. Also, in regards to other doctors we may work with, those that are looking to expand or remodel their space, or if they're relocating, this can be a huge opportunity to, frankly, help pay for some of those additional chairs that you may be buying when you're looking to do any kind of remodeling. Because if you're taking on more space from the landlord, or if you're making a substantial investment into the landlord space, it certainly doesn't hurt to ask for a little bit back from the landlord. And there's a lot of opportunity there. Additionally, we do work with doctors who think they are overpaying in rent. And it's quite common, frankly, that you'd be overpaying in rent, or CAM, the maintenance fees as well. We recently had a doctor that we worked with that was paying $36 when everyone in the same building was paying $23. So we successfully negotiated a new term for them. And just based on that, having someone renew their lease through a 10-year term, we saved them $23,000 a year. There's a lot to be had here. That's for sure. So again, how we negotiate the lease is dependent on a couple of things. And the first thing is we need the data. So in regards to that data, we utilize a software company out of DC for this data. The company has access to 95 billion square feet of real estate information, 4.6 million properties tracked. We can pull items such as comp reports to compare the rent data. We can have a discussion surrounding demographics for those that are looking to decide, should I leave or where should I build? Demographics, that getting a sense of your market size will be vital here, right? So to give you a sense of some of the other data, what we're looking at next is, well, what we're tracking in terms of vacancies and market rent. So, to give you a sense of some of the trends here, what we've been seeing is, depending on your location, the type of property, we've seen certainly, especially in the office space, depending on the city, office real estate has taken a significant dip. We've seen through COVID, through work from home culture, there's been a ton of vacancies in offices. But that doesn't mean that the ground floor retail has been left alone either, right? We've certainly seen much higher default rates throughout COVID, especially for example, the restaurants and cafes and other businesses like that. So what we're talking about here is, in terms of your financial impact, or the rent's financial impact to you, this, in terms of what you're paying the landlord, although it may appear as, for example, a $5,000 rent payment every month, it has an enormous impact to you over the 30-year span. In fact, it's a $2.9 million impact, right? So as I said, the moment you sign that initial agreement with your broker to lease a new space, and you're signing a 10-year term, it's not just $5,000 a month. It's not just a 3% annual increase. What this means is, over a 10-year period, potentially it's $1 million over your practice lifespan over 30 years. This is an enormous investment for yourself. But from the landlord standpoint, this is a huge check for them. So they have a lot invested in having you as a client as well. So on that, how to maximize your leverage. As I said earlier, frankly, you guys are the best tenants on the planet. You've got the lowest default rates. I had a recent meeting with a local bank, and they indicated, frankly, they love dealing with dentists because over COVID, over the past few years, they've determined that the default rate is 0.049%, right? And more often than not, it's not the fault of the dentist. It's not the fault of the business. It's not because the business is failing. More often than not, the default is because of some kind of personal issue, perhaps a death or a disability or otherwise, right? So frankly, dentistry, having a dental tenant in a landlord space, it's a sure bet. Now, as I said, putting yourself in a landlord's shoes, you know, these are all great. Having a dentist in the space is great. But what we've also seen over the past few years is, there's always this discussion about rates going up for lending. And if there's a loan on your building, if the landlord has taken over recently, they're feeling the squeeze just like everyone else. So the dentist, as the most secure tenant in the space, unfortunately, they're very likely to be the first one to get squeezed. So we can do a lot to help ensure that, although you may want to stay there for 10, 20 years, we want to make sure that your stay is as profitable as possible and make sure that the landlord doesn't take advantage of that. So in addition to that, in order to do that, the key thing is you need to make a plan, right? What's the long-term projections for the space? Do you have adequate space right now? Is the area that you're in, is it adequate? How's the market size? What's the projection for the building? Does the landlord have any plans for the building? We need to be able to plan and prepare for any kind of possibilities regarding that. So in terms of maximizing profitability for today through the lease, what we'd want to do is leverage 7 main financial variables in your lease. We want to touch on your base rent. Certainly base rent is always a consideration. Annual increases, common area maintenance. That's a huge one that people typically don't know that is negotiable, right? Your garbage disposal and your landscaping. There's certainly a number of things that we can potentially discuss with the landlord in terms of what you're paying. We want to be able to ensure that you're paying the fair amount, your proportionate share of those fees, no more than that. And we certainly don't want the landlord to take advantage of this and turn your common area maintenance into an avenue for additional revenue or profit. For those that are looking to build a new space or expand into potentially adjacent unit, the fixturing period will be very important. Fixturing allows your contractor to build the space rent-free. What I see frequently is, well, sometimes we find that brokers take advantage of this and they don't provide, frankly, enough. So we wouldn't want a situation where, frankly, your business is not generating revenue yet. You're still in the midst of building, but you're now finding yourself in a situation where you're paying rent. And then quite common as well is if you're, for example, signing a 10-year term, you're signing a new lease, you're signing a $1 million paycheck to the landlord, very common to also negotiate a free rent period, 1, 2, 3 months of rent. Heck, we recently had somebody that did an expansion into the adjacent unit. They took 1,600 square feet. We negotiated 6 months of free rent for that individual. On building, tenant improvement allowance is a big part of the discussion. Certainly, building a new practice or expanding, it's not cheap. I would be cautious about tenant improvement allowance. We've, described it as fool's gold because certainly the landlord is not in the business of loaning money. The question is, where's that money come from when they're providing this tenant improvement allowance? What happens often is that the tenant improvement allowance is baked into your rent. So if you were to take a certain amount of tenant improvement allowance, it might bump up your rent. We hesitant to take on too much because of the long-lasting implications of having higher rent, especially at time of transition. So there's certainly some play that can be had there. We can always discuss how much can we take on without significantly increasing the rent. And then finally, there's always landlord work. There's always a discussion about, if we're about to spend substantial money into the landlord space, is the landlord willing to also pitch in with some of the bill? So, what should the office lease do for you? Well, there's a number of things that it needs to do for you. It's certainly not just how much you're paying every month, although that's of course very important. What it also does is it provides long-term stability for you through the lease. What we can do is we can ensure that, frankly, your practice, if you spend substantial money building it out, what we see is $250 to $300 a square foot, even $350 a square foot for a build out nowadays. You certainly want some assurance that you can practice there for as long as you want. The lease will dictate that. What we've seen recently is, certain risks in the lease, for example, demolition clauses and relocation clauses, that can certainly have a detrimental impact to your ability to practice and be profitable. So we want to be able to minimize all those. We want to be able to maximize your flexibility within the lease as well. So if you ever desire to, for example, if you had 2,000 square feet today, and there's a possibility that you would want more, having right of first refusal built into the lease can certainly accommodate for that. Also, the lease, again, it has a huge impact on your ability to transition. And what we'd want to do is create some flexibility in regards to when you can transition, who you can sell to, and how that process is going to play out. In terms of some of the recent work we've done with some individuals here, we've had a doctor recently in New York that originally came to us looking to open to move their practice, and they were originally looking to renew. What we did was we ended up relocating them to a different building. This was in Midtown Manhattan, and that landlord was very happy to take on the dentist as a tenant. In fact, what we got was free rent period. We worked out a 10-year term for their 1,700 square feet. They have the options to renew, and the landlord paid for the build out. $250,000 plus of improvements were supplied by the landlord. Again, you guys are the best tenants on the planet. There's a lot of leverage here. We also did this recently in Long Beach, where we had a client that had a new landlord come into the picture. And certainly, when there's a new landlord in the mix, the situation can get a bit dicey. We don't know, the plans of the landlord for the new building, whether they're looking to, rearrange the layout of the building, if they want to redevelop. There's a lot of uncertainty there. So what we did was we going through the negotiation process, we determined that this particular building wasn't going to be the home for this dentist. So we ended up relocating them to a different building. And again, the landlord was more than happy to take on the dentist as a tenant. $153,000 went towards the client's practice in order to build. On top of that, they got $45,000 of free rent to sign that 10-year term. Again, there's a ton to be had here, guys. In terms of, profitable growth, what can we do here? We certainly want to strengthen the lease language to accommodate for things like usage. What are we talking about here? We're talking about your ability to practice the type of dentistry that you want. We definitely want to touch on, your ability to bring in specialists. And through the use provision, there's always a discussion about potentially exclusivity, especially when it comes to the ground floor retail that many of the general dentists want nowadays. The use provision, having a sharp use provision and adding in exclusivity will definitely be beneficial here in terms of strengthening the practice now, but also in terms of your eventual exit. Now, also in terms of your ability to practice and, bring on some additional doctors, some additional help. This particular piece is going to be quite important. So what I see frequently is, we'll cover this a little bit more, but in the assignment section of the lease, the assignment allows for you to bring on other people to transfer your lease, but it also controls subtenants and potentially associates. So there's certainly a distinction between a 1099 and a W-2, 1099 being a totally different corporation. If from the landlord's perspective, if you have a different corporation operating in their space, they potentially have two corporations operating in that one space. The question comes up, if I have two businesses in my space, do I charge more rent as a landlord? So this is definitely a big consideration to have if you're deciding to take on 1099s versus employees. There's definitely some work that should be done to the lease language to accommodate for that. In addition to that, we definitely want to discuss, Bob, perhaps you can touch on this a little bit more later, but buying a property versus leasing. Certainly what we found that is that buying a property, certainly it has its benefits. You get to have ultimate control over the property, but it certainly requires much more substantial upfront investment. Certainly, for those that own, what we found is, there's always discussion surrounding passing on in terms of your estate and so on. And, income post sale as well, post practice sale. You can always use the building as a passive form of income. But of course, you have to be the lender to someone else. So there's always some pros and cons regarding that. Now, if you're looking toward leasing, certainly there's a much smaller upfront cost. And, what we find is, especially with some of the larger entities, the DSOs, more often than not, they don't own any real estate because they want the flexibility to move around, potentially purchase practices. If you spend $1.5 million on a building, that's 1.5 you don't use to purchase another practice. So some other questions that we'd want to go through here in terms of leasing, some really good ones to ask yourself. You really should be asking yourself these questions when it comes time to do renewal, or even, getting the wheels in motion to plan your eventual exit. Some items like, when does your lease expire? It's still surprising to me to find out how many dentists don't know when their lease expires. It's typically your second largest expense. Very important to keep an eye on that. Also very important is when your option to renew deadline date is. So if you have options to renew right now, you absolutely need to know when your option to renew deadline is. If you somehow miss that option deadline, those options you thought you had, they actually become null and void. You lose those. So very important to keep an eye on those. Also, in terms of your eventual exit, your eventual sale, you may be a little bit early in that process, but it'd be good to have sort of a general idea of when you're looking at transition, because in terms of the lease, a lot of your transition is dictated on the term that you have, how much time you have on a lease. In addition to that, how many options do you have, and are they in fact transferable? If I'm a buyer that's looking to purchase your practice, I need to seek out financing, and part of that financing is determined by how much term you have on the lease, including your options. If they are not able to be transferred to me, I simply cannot finance your practice. So very important to keep an eye. Also, in terms of your personal liabilities, your liabilities after you sell, we certainly want to be able to watch out for any possibility of you being on the hook even after you sell. In addition to that, in terms of preserving your sale proceeds, demolition clauses and relocation clauses have a huge impact. What we've seen recently is detriment to the value of the practice of $200 to $300 a square foot with a demolition right in the lease. And finally, what is the state of your estate on a scale of 1 to 10? Have you done your wills and estate planning? Some of the other items that we'd want to look out for in terms of your estate. Who owns your building? Is it personal or is it corporate right now? Does your DPC own your building, or do you have a separate holdco for that building? Also, who owns the practice? Is it personal or is it corporate? These have huge tax implications. I'm sure Bob can touch on that a little bit later. Also, in terms of your rent today, this is actually a huge piece of tax savings potential. Are you actually paying yourself rent, right? In addition to that, it's very important to note, are you paying yourself the correct rent, especially when it comes time to transition for those that own the practice. For somebody that's looking to purchase into your practice, having the correct rent is very important. In addition to that, do you have a lease between your DPC and the corporation that holds your building today? Again, it's going to be a huge piece, especially if you're looking to hang on to the building post transition. In addition to that, we definitely want to look at, again, if you're looking to sell, are you looking to sell both the property and the practice together? More often than not, what we find is some buyers, they simply can't purchase both of them. It can be quite a substantial investment depending on your market, right? When we're seeing practice valuations at 5-6 times EBITDA hitting $2 million, and then your building selling for additional 1.5, that's a large chunk of change for a new graduate to potentially take on, right? So you might need that lease to separate the two entities, and you might need to be a landlord to someone else for a little bit while the buyer of your practice builds up equity. And in terms of transition, some of the terms that we definitely want to look out for in that eventual transition will be the assignment language, as I said, again, transferring your lease, your rental rates. Certainly if you have a buyer that's at the table, they'll be looking at how much they're going to be obligated to pay the landlord over the next 10 years. Other language consideration is a piece of the assignment language. What we see, it's a very interesting piece. What we've seen recently is landlords are getting a little bit crafty, and they're asking for a part of the sale proceeds in regards to signing the lease. So as a consideration to assign the lease, they may ask for a bit. Also, if you ever decided to relocate the practice, surrender provisions, surrendering the premises upon your exit of the premises. Are there any obligations for you, the tenant, even if you're exiting, to potentially restore the restore the premises to pre-dental condition? Also, in terms of death and disability clauses, this is an effort to potentially reduce your liability while you're in practicing, right? If something were to happen to you, typically what's written in the lease is that all leases are binding to successors and heirs, right? So having death and disability clauses in the lease will reduce how much your next of kin is exposed to any potential liability. In addition to that, personal guarantees. Are you personally liable? Are you on the hook if something were to happen, if there was a default situation with the DPC? And then, of course, financial terms of the lease as well, relating back to the rental rates and the increases. Some of the other language here, I mean, frankly, we could go on forever. We could take all night with this. There's certainly a ton more here that we can go through. But for the sake of time, these are certainly some of the huge ones here. Your demolition clauses, your relocation clauses being quite significant. But in addition to that, of course, financial statements, something that's a bit innocuous, but does the landlord have the ability to determine how much you're making in your space? And as a result, if they know how much you're making, is that going to change your rent come time for renewal? This has become a big question here. So for these next slides, I wanted to highlight something that's quite important, especially when it comes to those that are looking to eventually exit and transition, especially those that are looking to do this in the next few years. This section is going to determine all of that. So, I mean, I'm sure that most of the audience doesn't have as much fun reading leases as I do, but when it comes to this particular section, it's definitely one to pay attention to, because this highlights the entire process of your sale. So the first piece here is that although this may be, let's say, legal gobbledygook, right? That there's a lot here that needs to be highlighted. I get paid to be very picky with the language. With the first section here, it indicates that if you're looking to assign the lease, i.e., if you're looking to hand over the keys to someone else, you need to ask permission of the landlord. It's their space. They need to know who's coming in. The problem here is it doesn't indicate anything regarding do they need to say yes or say no. The second piece of this is, well, what is the landlord's ability to say yes or say no or to approve this consent? It indicates here in this particular section that the landlord has the option to, one, approve the request to assign the lease or sublet, or two, decline your request. That certainly is not ideal. The third piece is definitely not ideal. The landlord may have the ability to terminate your lease agreement upon the effective date of such proposed lease assignment or sublet. So this type of language, guys, it's quite landlord friendly, simply for asking to assign the lease to another entity, to another dentist. The landlord has the ability to terminate your lease, get you out of the picture, and deal with them directly, and potentially save that particular person your your sale proceeds, right? So with a small, potentially a small increase in rent, they'd have the ability to bring on a completely new tenant. In addition to that, what we see here is the landlord might even have the ability to revise the minimum rent to be paid during the remainder of the term. We had this happen quite recently. There was a dentist that was, let's say, in California, and the practice they were looking to purchase was paying $32 in rent. Upon buying the practice and being assigned the lease, the landlord said, no, 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 you're not paying 32, you're paying $51 a square foot. So we don't want the landlord to see your potential sale as an avenue for them to increase the rent. In addition to that, as I touched on a little bit earlier, landlords are getting pretty crafty with this particular language. You know, a lot of times what they're indicating is your sale, your successful business is partly due to my location. It's my foot traffic, it's my parking, it's the beautiful view, the windows you have. So part of your sale belongs to me. And that's what this particular section indicates. Any consideration from such sale of tenant's business with respect to the location of the premises, but not tenant's business, goodwill, inventory, and so on, shall be payable to landlord. So quite common now. There's actually one landlord that's, we'll call him a very significant landlord in North America. This has become a big point of contention for them. In addition to that, the last piece of this at the very bottom says, notwithstanding, even if you sell the practice and assign the lease, and you know, assuming everything goes well, you walk away with that $1.5 million paycheck, you might still be on the hook. You might still be liable for what happens after. So if your potential buyer somehow defaults, if they've taken on too many debts and they have trouble paying the rent, unfortunately, the landlord might give you a call at that point. So as I said, you know, some of the costly mistakes here, the inability to potentially sell, the landlord might potentially thwart the entire sale or take a proceed of it and keep you liable here, right? So this is one of the big sections that we definitely want to work on to maximize your sale proceeds. Now, in terms of when we get involved, you know, we like to say there's a certain cycle to the lease renewal. We usually advise that it's important to begin discussions 1 to 2 years before expiry. The reason is, well, frankly, if you approach the landlord, let's say 4 years before expiry, the landlord knows that you're not leaving the space. You're there for 4 more years, right? Conversely, if you approach them 1 month before expiry, it's very difficult to move a dental practice. And the landlord knows this and they can leverage this. So with 24 months as the ideal window, theoretically, if you had to leave, if something went south regarding the negotiation, you potentially could leave. Landlord knows that. So definitely starting a little bit earlier is preferable in this particular scenario. Now, in terms of how we would get started, certainly you want to, you know, get all your ducks in a row. You want to get all your correct documentation. You want to identify your particular goals for the practice. You want to be able to also review all the lease documents for potential risks, like we talked about, the assignment language, your rent, your ability to have exclusivity over the premises, demolition clauses, and so on. And then we'll do research for your area to determine how is your rent compared to the rest of the area. If your plan is to potentially relocate, what's out there? What's the potentials there for that? We want to create a strategy with you to determine, okay, what's the plan? Are we looking to potentially renovate now? Are we potentially looking to relocate now, or is the better plan to potentially stay? Notice within these 5 sections, we haven't done any of this yet, talking with the landlord. You know, this is all planning before this. So only up until these 5 steps have been taken do we begin engaging the landlord, talking about some of the economic terms, your base rent, your annual increases, free rent, and so on. Then we negotiate the other terms of the lease. So, for example, your assignments, your personal guarantees, death and disability, and so on. And then finally, once that's all done, we want to be able to review all the documents so that it's all consistent with what we've talked about with the landlord. So, guys, I highly encourage you to do this as well. We've, as part of this seminar, we were providing a complimentary lease review to go through exactly all the items that we've talked about right now. You know, in terms of the death and disability clauses, your rent, what you're paying right now, how does it compare to the rest of the market? How does your your location fare demographically in relation to others in the area? Is it the right time to move? Right? We can look through all those items there to determine you know, what the plan is, what the plan could be. And frankly, guys, as I said, there's a lot of possibilities out here to potentially save you money in the next year or two. So, you know, on that standpoint, I'm sure Bob has a ton to say regarding saving money. 30 years of experience regarding saving money.
Yeah, let me jump in and get started on that part of the program. We're probably going to run a little bit over tonight. I apologize, but hopefully that everybody's going to find the rest of the program as interesting as the first part. Thanks, Jason. And we will going to leave some time at the end here for questions, because I really want to make sure that for everybody that's here tonight, if you do have questions, go ahead and put those in the Q&A section, and we're going to try to address those tonight before we go. We got the quick disclosure. Of course, Henry Schein and Cirrus are not really technically in the business of giving tax advice, but really the whole point of tonight is just some more to light the fuse. We want to have have you create a conversation with your current tax advisor on things that may apply to you. I am Bob Gray, and I'm actually very proud to be one of the founding members of the Academy of Dental CPAs. It's a group of accountants that all actually know where tooth number 8 is, and mesial from distal, so it's kind of a strange bunch. But I'm one of the key instructors for the ADCPA's Business of Dentistry courses, obviously tonight in the Shine Academy, but I also do a lot of lecturing around the United States to different dental societies. So you may have seen me around. I've been around, again, for several years. I don't know if anyone's ever heard of the ADCPA. Hopefully we're not the best kept secret in the planet. The ADCPA has members all over the United States. And these are all accounting practices that are specific to dental practices. They all specialize in working with dentists. And so if you go to adcpa.org and click on the map, you can find one near you. And many of them do have clients all over the US. I know we have clients from coast to coast. So if you're looking for someone locally, you could find it on the map, or any one of the members could probably help. People ask me all the time, well, Bob, aren't the tax rules all the same? What's the point about specializing with dentists? But what I find is that if you really don't know the kind of deductions that dentists should be looking for, then the dentist is forced to ask the questions. If we specialize, we can go to the dentist and say, here's the things you should be looking for. Here are the things that would probably apply to you. And so that's really the point of the ADCPA. So as I said, if your accountant can't point to tooth number 8, find one who can. Tonight I want to talk about the things that people miss quite often. And I would tell you that the QBI deduction, the qualified business income deduction, is probably the number one thing I want to focus on tonight. I'm going to have an example. We're going to talk about that in detail. The pass-through entity tax is the ability for your practice to actually pay your state income taxes for you and take a deduction. I hear a lot of questions about Section 179, bonus depreciation for purchases. What's the difference? How do we talk about that? We're going to talk about that. Retirement plans too. A lot of people, get in the habit or just have the same plan and don't really ask the question, is this the right one for me this year? Am I meeting my goals? And we're going to talk about some other planning tips, but let me jump in right away. Here's an easy one for tonight. The standard deduction. They raised the standard deduction significantly back in 2018. And you can see now for a joint couple, it's $29,200. That means if you don't have a mortgage, if you don't have real estate taxes, if you never gave money to charity, if all those things, you still get a deduction of 29,200 if you're married. And so the question becomes, well, now you can see in this first example where I said even gifting, here's a person who gave $4,000 to charity. So the total, they had 29,000 here of itemized deductions. But the reality is that 29,200 was the amount they got to take anyway. So none of these really counted. So I told my doctor, well, think about the possibility, he was like to be giving $4,000 per year to his favorite charity. I said, tell you what, instead of giving them 4,000 this year and 4,000 next, bundle up those two things and tell them this is the 2025 gift in advance. I'm giving you 8,000. And you can see what happens. Now I go over and I actually have a $1,520 federal tax savings from paying the same amount of contributions, but just lumping them into 1 year. So that can be effective. We talked about the QBI deduction. I would tell you that the definition of the QBI deduction is a 20% deduction from all of the non-W-2 income from the entities that you're a member of. So if you're a sole proprietor, a partnership, an S corporation, the money that comes through to you on your Schedule C or your K-1 form, not your W-2, is potentially subject to this 20% deduction. What a great deal. I only pay tax on 80% of my money. I just get to ignore 20% of it. And that's why so many people just realize at the end of the year, I saw it on my tax deduction, but I never knew what it was. And so I didn't really plan for it. S corporations really have to plan for it carefully because remember, it's not your W-2 income. So now you need to find a way to legally minimize your W-2 income and maximize your K-1. Books have been written about that. We can talk about that, but go talk to your advisor about what the least reasonable salary may be to help you win that QBI battle. And again, just make sure that you can get your profit below some of the limits. I'm going to show you an example coming up here. We'll tie this all together at a different screen. First, I want to talk a little bit about, though, purchasing equipment, and you'll see how these things do tie together. For 2024, the Section 179 limit is $1,220,000 with a spending cap of $3,050,000. So if you spend over $3,050,000, you're not eligible for 179, but probably is going to keep most of you in check. 60% bonus depreciation is unlimited. Whereas again, there's a limit on 179. There's no limit on taking 60% of the value and writing it off all this year. It does work for new or used equipment as well, so keep that in mind. It really does have to be placed in service, however, by 1/1/25. I get the question all the time, well, Bob, if I write them a check or I sign the invoice real quick on December 31st, do I get to deduct this equipment? The IRS says the correct answer is it had to be actually placed in service, which means unboxed, plugged in, and ready to go. Didn't have to actually be used, it just had to be available for use. So those things where you write a check and then it gets delivered in January are technically not correct, although I do know, again, it happens from time to time where you see the invoice, it's got the right date, whatever, but I just wanted to tell you what the right answer to that was. And remember that some states deal with 179 and bonus differently. Some permit one, some permit the other, some permit neither. So you have to really look at your state tax to decide maybe which one of those methods is best for you. But well, I want to show an example of how powerful this purchasing of equipment would be. Here's a simple example of $150,000. Okay, you purchased $150,000 worth of equipment, and this year, before the end of the year, and if you bought that one of those financing options where you have 6 months of no payments and they're postponed, you would save $45,000 in taxes for 2024 but you would also save another $10,000 in estimated tax payment requirements for next year. So that means by the time we get to April 30th of 2025, you've saved $55,000 in income taxes, and you haven't paid a dime yet towards the equipment. You borrowed the money. So you got 55,000 extra in your pocket just because you signed that contract. I mean, it's a very big deal when you're talking about the possibility of purchasing new equipment. People, again, they forget that it's not just the year that you bought it, it's the next year too. Because for the next year, your tax payment requirements are 110% of the prior year if your AGI is more than 150. So lowering the 2024 taxes has the effect of saying, listen, now I could lower my required estimated payments for the next year. Doesn't mean it's tax-free, but in this example, this doctor got a $40,000 break on the required payments now for 2025. And if I guarantee you, for anyone listening tonight, if I said, I'll give you $40,000 now, there's no interest and you can pay me back on April 15th of 2026, that's a pretty good deal, right? So keep in mind that that kind of cash flow is pretty powerful. People ask me all the time, well, no, Bob, I don't have an LLC or I don't have a corporation. How does that function? I can tell you this is the same benefits apply to every one of the entities. In an S corporation, you're basically lowering your salary, your taxable income requirement, because you've lowered the overall practice income. And so you lower the amount that flows through to your 1040. Even C Corps can benefit. It's more difficult because you got to do it earlier in the year, but C Corps can follow the same path as well. So it really doesn't make any difference what sort of entity you have. I'm going to pull this all together with an example here I want to show you. So the one problem with the QBI deduction is for dentists and professionals and a whole list of other people that unfortunately they limited it for. If your joint income, in this example, if you can see the top up here, if your joint taxable income it was between 383 and 483,900, that the ability to take that deduction starts to phase out. So by the time you got to 483,900 of income, it's completely gone. You now are not eligible for the QBI deduction. So let me show you an example here, the one where it says without Section 179. In the center here, if a client who did not purchase the equipment, he had $490,000 worth of taxable income from the practice, a few itemized deductions and things, and a taxable income of $461. So because the practice net income, the AGI, was too high, they did not qualify for the QBI. Look what happened, however. He bought $150,000 worth of equipment and lowered the taxable income now to $340. But look what happened here. In addition to the $150,000, this dentist got a $68,000 tax deduction for free, just called the QBI. So I only bought $150,000 worth of equipment, but look, I got a $218,000 tax deduction. And that was a $64,000 tax savings, all up front. And that means 43% of the equipment was basically free in total tax savings. So imagine how important it is as you go into the end of the year, if you have the ability to make decisions to advance expenses, to move income, to purchase equipment, to do things that would have got you. In other words, if you're over 483,900 as taxable income married, or 241,950, if you have the ability to get back down into that range, it could have a double whammy impact of not only lowering the income by the amount you spent, but another 20%. And that's why I said tonight that QBI, I think, was so important. Let me switch to the pass-through entity tax, because I still see a lot of people that have, not taken advantage of this. A pass-through entity tax is basically the ability for your practice entity, your S Corp or your partnership, to actually elect to pay the tax on your behalf that is due on your K-1 income. By doing that, the practice takes a tax deduction for that. But remember, that's wonderful, because the problem was back in 2017, Congress passed a limit to these state and local income taxes of $10,000. Well, a lot of people pay $10,000 just in real estate taxes on their house, and so they're not getting to deduct any of the state income taxes that they pay. By doing it this way, you're taking a federal tax deduction for that state tax paid. So it can really make a big difference for practices. And if you're any one of the 34 states listed below, you have the ability to do a PTE tax payment. Quick example here. Here's a dentist with an S corporation. Without the PTE tax, the doctor's W-2 wages, which were the same, had K-1 income and a total of 616. The difference, however, is when you now pay the state income taxes through the practice, the K-1 income dropped to $332,500. That was a federal tax savings of $6,100. And it's the same tax. It doesn't make any difference whether you paid it personally or the practice. It's the same cost, but now you get to deduct it. So a $6,100 federal tax benefit in this example. Obviously a pretty big deal. If you, and obviously the reason why I'm saying tonight, you should want to take advantage of the PTE tax. Excuse me. One of the other considerations about practicing or practice expansion, what I talk about, are cost segregation studies, because that can be a really big deduction. The other thing is the unamortized leasehold improvements. What a lot of people forget is that, let's say I moved into a place in 2014 and spent $300,000 in leasehold improvements, and now I've outgrown it and I want to move in 2024. Because you were probably required to amortize the cost of those improvements over 39 years back in 2014, you get to take an immediate tax deduction of $215,000, which is the unamortized portion, immediately when you abandon and walk out of that space. And when do you need the big tax deductions the most, right? It's when you're moving into a new space and you're taking on a big debt that, is a little bit, knuckle biting. The cost segregation I want to talk about, I call this how to turn studs and drywall into 179 expenses. The IRS long ago said that you must take a building over 39, commercial building over 39 years. I show it as 40 here because it's really half the first year and half the last year. It takes 40 years total to depreciate a building under that system. If you bought $1 million building, and you did it that way, it'd be $25,000 a year for 40 years, basically. However, with a cost segregation study where you break the building down into its components, it's easily able to get at least 20% into a 5-year category. And that $200,000 category is basically considered equipment. In other words, it's not building now, it's considered equipment and eligible for an immediate 179 deduction or the bonus depreciation. And some portion of it's going to go into 7-year for other, things around the building. Some of it's going to be 15-year as well. Then, so we take those things and keep them out of the 39-year bracket. There's a lot of numbers on this page, but the point was a lot of these companies will run these examples for free. So if you had $1 million building, they would show you exactly what the tax savings would be and over the first few years, and you could see whether or not it's right for you. I also point this out because this is a sample of a tenant, someone who did $500,000 in just tenant improvements. And you can see that the tax savings are very significant for doing that cost segregation study. So again, if you remember nothing else about tonight, just remember that there's 2 boxes. With the component, I was breaking the building down into those pieces. You can see 20%, 1%, 8, 71. Without it, I was required to take the whole thing at 39 years. So clearly, people asked me, well, so tell me again, Bob, what's that, what does that mean? Well, here's obviously an example. This is an outlet that's in a wall, and normally that would be 39 years. But with a study, you're allowed to say, well, what's plugged into that outlet? If it's fax machine or dental equipment, it's now dental equipment, and we're now back to that 5-year, thing. Same thing with decorative lights, sconces, things like that. They're no longer 39 years. They're back down to 5 or 7, depending where they are. All the plumbing, all the electrical that went into your dental equipment is now considered dental equipment. So you can imagine how big these deductions get for it. And what doesn't qualify is the actual load-bearing walls, roof, windows, exterior. And land never qualifies. Land is not actually tax deductible. But imagine it can make a very big difference in the tax deductions for a new project like that. I always say, just don't forget that you might want to time this. You're allowed to actually wait. Let's say you had a bunch of equipment purchased in the year that you did the move, and you already had a big tax deduction. You don't want to get your income down below 0. I always say taxes are on sale in that opening 10 and 12% bracket. You don't really want to waste these deductions in a 10% bracket to get your income down to zero. So make sure that you've planned this, because you might want to wait and do a cost segregation study in year 2 or 3 after the building is built, because you're allowed to go back retroactively then and pick up all the depreciation you could have taken. So keep that in mind. I want to talk very briefly about just the IRAs and Roth IRAs and 529 limits today. The HSA, which I just want to make sure a lot of people take advantage of, it's the health savings account. It's $4,150 for self and $8,300 for families. If you have high deductible health insurance, you want to consider those kinds of plans. The IRAs are up to $7,000 now, or $8,000 if you're 50 or older. And contributions to the 529 college savings accounts can be made up to $18,000 per donor without filing any annual gift tax exclusion. So there's you can basically make the gift per person. So husband and wife could give $36,000 to a child and in 1 year and not have to file any gift tax return. So it's pretty substantial. The contribution limits too for Roth IRAs are so even if you have a 401k or you've got some other income, you're allowed to contribute to a Roth IRA. The problem is that those income limits kind of cap out. As you can see, once a single person makes 161 or a married makes 240, they're no longer eligible. However, what you can do is what they call the backdoor Roth. And that's where you make a non-deductible traditional IRA contribution and then immediately convert it to a Roth. Why the IRS makes you do it that way, I don't know. It's a little quirk in the rules, but it does mean that you're still eligible to do it. You just have to go through both of those steps in order to get there. I mentioned taking the right pension plan. I would tell you that this is one of those common things I see that many people I'll review a tax return for a new client and we'll say, well, you've got this simple IRA plan. Yeah, I've had that for the last 20 years. Okay, well, doctor, is that the right one? Are you sure you didn't want a 401k or a defined benefit or some other plan? They just say, well, I just never asked the question. So again, periodically you want to stop and ask the question, what is right for me? Because you can see for a high earner, the 401k and the cash balance combo plan has a maximum contribution of $452,500 as a tax deduction for a 66-year-old doctor who might be late to the game and behind on their pension savings. So there's a significant difference between these plans. Make sure you've got the one that's right for you. Another really small thing, but I see this all the time. Recent graduates and younger dentists that start their own LLC and become independent contractors. They bought a lot of things when they were dental students, books, textbooks, loupes, articulator, hand instruments, all sorts of things. And they were not tax deductible when they were purchased for actual, educational use. But the minute that you now open your own LLC, all of those things that were now converted from educational use to business use are immediately tax deductible at their used value at that time. And so this can turn into thousands of dollars. Again, you might have had laptops and printers and all kinds of things that you converted, cell phones. Make sure that all of those things get picked up and tax deducted when you create these in the year that you open this LLC and start to become an independent contractor. It's a little thing I see a lot of people miss. I was trying to go quickly tonight because I want to save some time at the end here for questions. The big point is tax planning is complicated. It doesn't, if you treat your accountant like an archaeologist and they're just blowing the dust off what already happened and there's no time for planning, you're doing yourself a disservice. So try to make a plan and make sure you make the end of the year turn out the way you wanted it to. You can see the big impact that equipment purchases can have on tax if it's planned properly. Again, you definitely want to use the option of making a pass-through entity tax if you're in a state that permits that. I say choose wisely before taking accelerated depreciation, because remember, you don't want to take a deduction that got you down into that 10 or 12% tax bracket. I think you're wasting the deductions to get them down to that level. And again, I see a lot of times where these cost segregation studies are overlooked on big projects. So don't let that happen to you. I've got my contact information up here. I want to make sure that everyone's got my email address. If there's some other questions and follow-up things, I'll cry foul if it's something that requires 2 hours of research or whatever, but I'm certainly happy to answer some simple questions. You've got my phone number there and you've got my contact information, so feel free to, um, contact me if you think I can help. Jason, were there any questions that popped up in the queue?
Doesn't look like there's any questions at the moment, guys.
Okay. Well, I apologize again. We did run a little bit over, but again, you all have my email address if you copy that down. And if you do have questions and things that you want to follow up with later, feel free to reach out. I'm happy to try to help. Hope you guys all
Thank
found
you
this
all.
useful tonight. Thank you, Jason.
Thank you, Bob. Thank you, everyone else, for attending, and have a great night.
All right, thanks.
Bye-bye.